It's a day after the most recent and highly anticipated Fed FOMC meeting, and we're not seeing anything too extreme. We're seeing a relatively flat market, definitely lopsided a little bit towards the NASDAQ, but the Dow almost closed positive, closed just about flat on the negative tilt. Nothing crazy, in my opinion, going on. So how do we evaluate this period? Instead of focusing on these extreme categorizations, hawkish or dovish Fed, good earnings or bad earnings, I want to look at things more holistically and develop a more broad picture on how we have to evaluate these markets, because I think that's a more accurate way of looking at things right now. There's nothing extreme going on. And why do I say that? Well, the Fed has been extreme. It has been printing money, stimulating, buying a lot of bonds. Yesterday, though, they pivoted towards more normal. And they've said they're going to be on a path to normal. At the previous meeting before yesterday, Jerome Powell said it was going to be a long road to normal. Yesterday, he said two things that make me view it not as hawkish or dovish, but as neutral. And those two things are the desire, as he said, and the need, as he said, for a long, extended expansion. And that an expansion can only occur with price stability. Those two things, one may say they're competing forces, but they can be balanced, and it seems like that's the approach he's taking. And I think that's reflected quite well in the markets, because we're not seeing any sort of extreme move today. We saw some relatively extreme moves overnight, but that was counteracted by what he said yesterday coming to fruition. An extended expansion, a long expansion. What did we get this morning that counteracted that? We got a pretty solid by 1.4%, which is, in normal years, a modest GDP read in itself. We got a pretty solid beat on GDP. And we did have rising interest rates in this period. Rates did rise. Mortgage rates did rise during the last quarter. We had Omicron, and yet we still had very good GDP and a number that was closer to what was anticipated before Omicron. So we're now, I see, in a normal period, in a very normal period. And in a normal period, with slightly higher interest rates, we have seen the economy grow and expand. And we have seen the stock market continue to do well. So I think we have to stop getting pulled by all these headlines and this categorization of the Fed's activity. And I'm not trying to say the Fed doesn't dictate markets. It clearly has an effect on markets. What I'm trying to say is, let's not make our determinations based on trying to place all forces, all events occurring in the broader economy in one single bucket. Is the Fed hawkish and therefore sell everything? Or is the Fed dovish and therefore go in on all growth stocks? We want to strike a balance. We want to make appropriate investment decisions that make sense in this rather neutral environment. In this environment that's going to seek to bring inflation down, but at the same time, continue to see the economy expand. And that is his primary goal, is see the economy expand. And as he said, I believe the exact words were to no longer have inflation be entrenched. We need that inflation to not be entrenched to have the prolonged recovery. Okay, we did see the NASDAQ down today. Can't one make the argument that this was clearly a hawkish statement and tech stocks are going to go down? Tech is a very broad bucket. And I recently wrote an article about why I think now is the time to go in on the 10x growth stocks. Part of that is because prior to the last 3 weeks, when we had just seen companies like Apple at all-time highs, we had seen the most speculative but very solid 10x growth companies come down 50, 60, 70, 80% in anticipation of rising interest rates. So the market, in my opinion, at least in the areas that needed to adjust the most, has adjusted or even over adjusted for that possibility and reality. So yes, there are companies that do need to adjust for that reality, that do need to adjust for not having an expansion of the balance sheet and unnaturally low interest rates. There are big tech companies that recently peaked that are quite expensive, that have been flights to safety for flights to safety dollars, which might not have that same kind of demand, because that demand is now going to shift towards finally investable bonds that are historically the actual flights to safety, and maybe there'll be less purchasers of those stocks. Doesn't mean anything's wrong with the company. We just saw Microsoft earnings, but they're not going to have that hose being fed into their mouth anymore of flight to safety. Though that pocket might come down and might continue to come down. We're going to likely digest that. I'm not talking about anything extreme. I think this is a very not extreme environment right now. Not extreme environment, either in the bullish or bearish sense. But those companies that are most susceptible and are most feared to get hit by this have already been hit by this. So I don't think there's going to be an extreme event. I think there will be a slight, just taking some air out of the balloon that's left, because it's already pretty deflated in the areas it needs to be deflated in, or arguably needed to be deflated in. Some people would say no. I would say no in some stocks. And I would say those stocks present fantastic buying opportunities right now. We're in a very complacent environment, but that doesn't mean it's going to be easy. It means the actual environment is quite fine. This is not, we're not at the equator, and we're not at the North Pole. We're somewhere in Virginia. A very calm, temperate, normal environment that does have seasonality, does have temperature and weather, but nothing extreme. So the way I see the next couple weeks going is this simple digestion. Every stock has what's called an intrinsic value, an appropriate value. And some stocks have deviated from their intrinsic value because of forces like interest rates being so low and people needing a flight to safety. But because they're so low and inflation so high, bonds are not presenting that flight to safety. Jerome Powell said in the previous meeting, not yesterday, the meeting before, a long road to normal. It's not going to happen overnight, but over time, slowly, over weeks and months, we're likely going to see some of those large investment pools switch from having an overweight historically to tech stocks, shift back into U.S. Treasuries, which was the normal place they were. They'll have the normal ratios, and nothing extreme is going to happen. These people that went to the big tech stocks did not buy, for example, Editas Medicine as a replacement for a 10-year Treasury bond. However, the market has aggressively sold off those tech companies. And there's another argument. You can make the long-term cash flow argument competing for the long-term dollars of investment. But the people buying Editas Medicine are not comparing Editas Medicine to a 10-year Treasury bond. And they're certainly not doing that when Editas Medicine is down 80% roughly over the last year. They might be looking at that and saying, hey, I like this company. It's quite reasonably attractive. And I'm not saying tomorrow we're going to see a 30% rally in this kind of stock. What I'm saying is we're going to, over time, slowly in Virginia, not at the equator and not at the North Pole, see these companies hopefully push up if they're making good progress and they're actually good companies. Do so. We're going to see companies that have artificial dollars in them withdraw some of those artificial dollars and move them into bonds. And hopefully this will be a calm and temperate process. Nobody's going to get hurt, and it's going to be a return to normal. We're going to remain on the long expansion of the economy that was only interrupted by COVID, that was a very fruitful environment for virtually all companies, that had stocks go up at a normal rate, and it's going to be normal. There might be a little bit of chop right now, but after the Fed talked, we haven't seen a whole lot of chop. We saw all the chop before in anticipation, which leads me to believe the market was very choked up with hawkish expectations. And some are arguing the Fed was hawkish. Some are arguing the Fed was dovish. Some are arguing the Fed was neutral. I think this is all good. I think this is fantastic. We don't want to be categorizing the entire market and the entire economy in one bucket or the other and making 100% of our decisions based on which bucket we decide to plop things into. The economy beat expected GDP forecasts, and it returned to what they were before the negative forces, Omicron, came into the picture. So, normal environment, normal returns, great opportunities available given the massive hawkish expectations, which are not playing out to the same level of extremity after the Fed, thus presenting opportunities. So I am very happy to be a participant in the current market, and I think you should too. But if you're going to be a participant in this market, I hope this is made somewhat clear, I would advise you not to be expecting an extreme move in either direction on any stock unless you anticipate a particular announcement for that stock, and that's a side point, individual fundamental analysis. Play the long game here. Nothing extreme's going on, in my opinion, at least yet, obviously subject to change. We just kind of got to pick the right stocks, making the right money moves, and be investors. It is now time to return to the investor. So that's today's video. Until next time, peace out.